What's up, guys?
It's Rowan
And Terry.
here from Artismart TV, bringing you another episode of HSC Economics Review. And once again, we have got an epic fail on the sink as we try to do our intro via Zoom. But welcome everyone to another episode. We're really pumped. One of the things that we're unpacking in today's episode is just the fact that economics is a live subject, and what that means is that throughout the year, things are always changing, right? Policies, economic updates, statistics. And so one of the things that really helps differentiate students is the degree to which you can stay up to date with what's actually going on in the economy. Now, with COVID, the pace of change has accelerated. The pace of change in data and economic policy is much quicker than what typically would be the case. And so in this episode, we're going to be looking at a deep dive on what's been going on at an economic level in terms of statistics due to Delta in Australia and the lockdowns that have occurred. And then secondly, what is the government response? And the goal for this is really to help you guys get greater clarity on what has been happening in some stats and some examples that you could pull in to some of your essays, and also to give you a sense of the update on particularly fiscal policy, although monetary as well, given that they've had to adapt based on Delta and the unexpected lockdowns that have occurred. So let's dive in and start to unpack what on earth is going on. And I guess to start with, Terry, I think a good place is to really just lead with economic growth. Like, what is been the impact on economic growth of a lockdown in Sydney that is going on for months, a lockdown in Melbourne that has been going on for months and will continue, state border closures across the country, that was all largely unanticipated in the budget assumptions that the federal government released earlier this year.
Yeah, so I think it's important to touch on economic growth first, because it should be where your minds go first whenever you look at some kind of lockdown effect, right? It's because it's the biggest effect and it's the one which you can definitely write the most about, but it's also one that I think a lot of students sometimes might forget, because it just almost feels like we've said it so many times, it's happened so many times. Do I need to still say this? Well, unfortunately, the answer is yes, you do. Just because remember, the markets don't know that you know, so you just have to spell it out for them. So that's what we're going to do here as well. You've heard us talk about this impact of lockdowns on economic growth several times over the past 2 years. We're going to do it again, so bear with us. And so the Australian economy rose 1.8% in seasonally adjusted chain volume measures. Through the year, it's looking a little bit even less than that. So we're looking at 1.1% and just 0.8% in the June quarter. So 1.1% was in the March quarter and 0.8% in the June quarter. And it's looking like it's going to be a further contraction of about 2% and perhaps almost as much as 3.5%, which will essentially wipe out all the economic gains of the past 12 months. So talk about wiping off all that progress. It's quite sad.
I think that's an important point, I think, to highlight, Terry, there, because I think up until now, if you were doing an analysis of fiscal policy, for example, right, you would be, I think, broadly looking at it through the lens in terms of impact on economic growth very positively. That COVID, obviously, we had the dip, we had the 7% negative growth, but we then saw this really big recovery off the back of just both, yes, of course, low levels of COVID cases, but also big spending. And I think the fact that, yes, we don't yet have September quarter data, we've got June quarter data and it's the latest, you're right. Like, the expectation is that Australia will see 2 quarters, the September and the December go into negative, and therefore, once again, we're likely in a technical recession. And I think in many respects, like, that then starts to change a little bit, right? Maybe how positive you might be in evaluating the government's fiscal policy response, right? Like, yes, clearly it worked and it did a lot, but there is this caveat now that I think starts to emerge, right? Okay, surely some of this stuff should have been foreseen a little bit more based on global experiences. And to what extent then is the current fiscal policy, which we'll look at, of course, going to actually really get us through? So I just wanted to highlight, I actually think it takes what might have been a very positive analysis on economic growth and maybe brings a couple of question marks up.
And I think that's a good point as well, because even when we were making very positive analysis of the original budget, and economists were as well. I think a big question mark was, how is the immediate effect is great, but then moving into even just the short to medium term, is it going to be sustained? And I think as of right now, we're starting to get a bit of an answer on that. And so all that really does is just gives you more and more layers to talk about in your analysis, which can really, really help you build a really strong response.
Definitely. A couple of little things just to pull out. We can see that household savings, the household savings ratio had, decreased in the lead up, which I suppose was a good thing. And this is the sort of thing I think right on the money, Terry, with what you're saying. Like, we were seeing all of the things start moving in the right direction. We were seeing consumption recover. We were seeing investment recover. But when we now sort of dive in and take a look, right, you can have a look, and a couple of great places to go is, to go to the Westpac Consumer Sentiment Index. It's to go to the NAB Business Sentiment Index. I mean, these are great indexes that give you a read on consumer confidence, on investment confidence. And I think what's, really, really interesting is that you can see that, consumer sentiment, in August, was down. It was down 4.4%, but it was down in June. It was down in July as well. So really had a couple of, but on the back of the lockdowns, that consumption is really starting to slow. Equally, what we were seeing was that business confidence, actually turned negative, right? So it went from, on the index, 20 in May, 11 in June, to -8 in July. And so if we're sort of looking at those sort of, if we look at economic growth being just aggregate demand, C plus I plus G plus X minus M, we're seeing two of the key drivers, consumption and investment, and the forward indicators really of what they may bring really starting to plummet and start to, in the case of investment confidence, move into negative territory. Certainly in the case of consumption, start to fall again. And I think that definitely is what highlights that the economic growth, and the sustainability of it is questionable. Now, I think the reason I bring that up, and we're not going to get here just now, we will, later on in this video, unpack the policy, but it's also then a good way to help you evaluate the policy response, right? Is to go, hey, okay, given that these are some of the key sort of, goalposts, so to speak, right? Consumption, investment not looking good. What's the government doing to support these that will then drive that economic growth? And so let's just keep that in mind as we get in later on into the government policy. We'll come back to that. But I think that's, again, just a little bit of maybe how to think about your analysis as well.
Yeah. No, you're absolutely right, Rowan. But I think one thing you mentioned the aggregate demand and the consumption and the investment. One other thing I just wanted to talk about very quickly was just the exports. And I think, when we talked about last year, just exports really carrying some really strong growth for us due to high commodity prices, particularly in iron ore and LNG. I think, again, we raised that question at the time, is this necessarily going to be sustained? And from what I've seen in the past couple of weeks, it's not, because the iron ore prices have actually started to drop quite significantly from their record highs. And so it almost just feels like the perfect storm that got us to where we were in a good position is now all coming back together, just to take it all away from us all in one go. So probably not something we talk about policy-wise, but it's still something I think something we can.
But I think that's important though, right? Because I think, you're 100% correct. Like, we have really been very fortunate that we have had a terms of trade that has been at, all-time highs almost, right? Or if not incredibly, well above long-term averages. And we've been reaping the benefit of that in it supporting our economic growth as a bit of a buffer. And so, exactly, it does raise big questions. And I think it's worth, I think, you need to be succinct about this, but you could certainly be highlighting that as like a forward concern, just in the fact that, okay, yes, how sustainable will the policy response be in achieving the outcomes we want, given some of the changes that will start to occur in the global economy? Terry, what has been happening with unemployment? I mean, obviously that's sort of a bit of a picture in economic growth. What's been the unemployment picture? What's been happening?
Weird things have been happening. So our unemployment rate's gone all the way down to 4.6%. Unfortunately, we're not going to have, the most recent, data once we really feel the brunt of these lockdowns. But when you just look at that 4.6%, it just looks unreal, almost a little, just unreally low. A couple other things, we've got all the way back up in the 66% range. So we've gone basically to where we were pre-COVID. Our underemployment has actually started to creep up a little bit to 8.3%. Youth unemployment's actually stayed quite constant. And in fact, it's actually even a little bit lower than what it was right at the start of the pandemic at 10.2% right now, as opposed to 11.6 earlier. So,
and I think the really interesting thing as well is, I think you're right, like the data has not yet sort of come out, but there is some emerging data. And I think some of the emerging data is really quite interesting because it's really looking at where Sydney is, as an example, given that Sydney is quite a strong driver of the broader both economic growth and employment levels across the country, where Sydney is at relative to sort of Melbourne during Melbourne's lockdown, particularly from a policy perspective, right? Because last year, and we're going to talk a little more about this when we look at the government response, but last year, JobKeeper was in play, JobSeeker was in play. And it was arguably, that the data that's emerged, and hopefully you'll be perhaps saying this in part of your analysis, was that it was very successful in really preventing unemployment from blowing out, beyond, I think, a peak of 7.5%, give or take, right, where it got to. Where what's interesting is that we're in an environment now where JobKeeper isn't at play. And, the concerns that have already been raised by economists is that, the pace of job loss in Sydney relative to the pace of job loss in Melbourne last year, when Melbourne was under a similar length of conditions, has been much quicker. And so you could expect, actually, as a result, that, we could see a bigger impact on unemployment than perhaps what we saw last year. Again, it's hard to tell, but I think you would certainly be wanting to sort of be highlighting, look, that's definitely one of the concerns. And we can see that in a moment when we unpack just what the government policy response has been and the amount of people that are actually availing themselves of that support. Because I think that tells you quite a lot just around sort of hours of work. Was there anything else you wanted to add, Terry, around, the unemployment context?
No, not really. Happy to move on.
Yeah, cool. So then we've got inflation. Now, I think inflation's been a little bit of an interesting one because I think in some respects, we've had, a fair bit of inflationary pressure start to sort of creep into the economy. I think certainly, just as a little bit of an update, like CPI, which is the Consumer Price Index, that grew 0.8% in the June 21 quarter. However, if we look at the 12 months to that quarter, inflation was at 3.8%. And look, a lot of that was simply, I think, just because of, like a rebound, right? The economy was bouncing back. Oil prices started really lifting, just due to the fact that globally economies were opening up and the demand was growing. And so that was a pretty big driver of an increase in inflationary pressures. What else, Terry, was driving some of the inflationary pressures we've been experiencing?
So if we just look at the components within the actual CPI itself, and it's always good to just take a bit of a deeper dive into this because the numbers will really start to stick out quite quickly. So our biggest rise was at 16.9% in furnishings, household equipment, and services. So it looks like, people have really started to get comfortable with this concept of working from home, and they're really, really boosting the demand in that particular area. We've also got an increased cost of transport, which I'm going to believe is due to just the fact that oil prices have started to also pick up as well. And so it's very, very logical to see, those two areas just start to pick up a little bit.
That's right. And there are a couple of other broader things as well. If you look, like federal government had the home builder policy, which was really, providing grants to encourage, renovations or, extensions and new property development. And so that also, has, I guess, played a role arguably in driving, new dwelling purchase and owner occupier as well. And so I think the big thing that we've seen, right, is that, without the offset of the grants that the government has been providing through this, new dwellings would have risen in terms of, the data they have here by 1.9%, reflecting the demand around materials and labor costs and just the inflationary pressures that were happening in the construction industry. So I think what's interesting about this is that we're now in lockdown, and so we're probably going to see some of those inflationary pressures potentially ease because of consumption dialing back and, consumer confidence being lower and investor confidence being lower. Clearly, though, part of what has been supporting this is not just fiscal policy. I think that's important to note. Like, we've obviously had quantitative easing going on, to the tune of 100 billion. And so that also is just driving increased money supply in the economy, which generally lifts inflationary pressures. Now, 3.8 on the face of it, you might think, oh, well, isn't the inflation target 2 to 3? Well, yes, but that's during, sort of fairly typical economic growth periods, right? Clearly coming off, a technical recession, you would expect to have inflation levels that are above, the 2 to 3% bracket. Creeping closer to 4 is not unexpected. So I think looking at that, right, we're not sort of really going to say, well, that's a cause for concern. I think there was some interesting analysis, though, the HSBC Australian chief economist had on this. And what was he sort of drawing attention to?
Yeah, so I think he was more interested in just the supply side more so than the demand side. So remember that inflation come from the demand pull and the cost push. And he was really concerned just about the fact that population growth has just significantly slowed just because we've turned off that migration tap, as we've said before. And so without this equivalent increase in the population size, it makes it very difficult for us to get sustained growth without it then having some kind of effect on inflation due to a lack of skilled labor. And when you have a lack of skilled labor, that's going to put pressure on wages to increase. And so when we look at the potential of how quickly we can actually grow, it's actually gone from about 2.5% to 2.75% down to about 2.25 to 2.5% before we start incurring inflation.
Yeah, and I think what's really interesting is that I think at the moment, I think Bloxham even says right now, like, I think that's the medium-term growth, right? Because he's expecting that there will be some opening up of migration and so forth, right? He was even saying that right now, to not generate inflationary pressures, we would only need to be growing 1.3 to 1.6. So even lower, right? Which is quite interesting. Now, of course, the tension here, and it's quite, I think, a little bit of a tricky policy sort of response and balance, because the argument here is each percentage point is the equivalent of $20 million in economic activity and thousands of jobs. So those sort of small differences in, what level of economic growth you can grow at that doesn't cause inflationary pressures has significant material impact. But alongside that, the trick is wage growth was one of the challenges we had in secular stag. So you sort of are wanting that. You are wanting a situation where you're getting it, and less skilled migration coming in sort of supports that increase in wage growth. But then the challenge becomes, how do you prevent that from then becoming a constraint on economic growth? And I think that's the part that is unclear. And I think it's hard to do as well. It's not like,
and I think as students, you don't need to necessarily have the answers for that. I think you just need to acknowledge that this problem exists.
Yeah, definitely. I don't think anyone has an answer to it, let's be honest. That's a good segue, I think, Terry, to just look at what's been happening with wage growth, because I think this has probably been the concerning thing that has really emerged, right? Like, if we were to pause right now, we would sort of say that at this point, from everything we've shared, short of the sort of forward projection that we're doing, the data looks good, okay economic growth, it's in the positive, unemployment of 4.6, a bounce back in inflation 3.8. Like, at the moment you would be going, okay, great, tick, 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 pending the fact that all of that will probably change due to lockdown until we get to wage growth.
Yeah. So we already talked about it. Like, it's like, as you said, we really want a bit of pickup on this, and there's good reason for that. Because workers have actually suffered the single biggest cut in purchasing power over the last 20 years. So we think back over the last 20 years, that's when we've introduced, enterprise bargaining. We've introduced all these measures to try and get productivity-based wages. which theoretically have been quite good in generating some good wage growth. We've had the biggest cut in the last 20 years. And so when you look at the stat, the ABS reports that wages over the past 12 months grew by only 1.7%. And as we discussed earlier, inflation rose by 3.8%, which shows that in real terms, people have actually been earning less money when you account their wages for inflation.
Yeah. And I think the reason why we've talked about the importance of wage growth has really been from a perspective that, wage growth and wages are the single most important determinant of consumption in an economy. And then consumption itself drives, up to 60% of your economic growth outcomes. And so wage growth is a really key lever. If you've then got purchasing power that's being eroded, you're going to have people ultimately spending less, which is going to then not bode well for long-term economic growth. Now, what Terry, I think you brought up that's fantastic, and I'd really encourage students, yes, we're talking about economic updates, and there's a little bit of a fiscal and monetary sort of skew to what we're talking about, but actually, this is really interesting data for you to pull into a labour market essay if you were evaluating the effectiveness, right, of labour market reforms, particularly, let's say, the shift towards decentralisation over the last 20 years, to be highlighting, yes, look, it has created an outcome maybe where unemployment is at 4.6% due to flexibility in the labour market. However, right, the consequence potentially is that while there was a fear of a decentralised wage determination system causing wage outbreaks and, the inability of a government through a central determination system to manage it, probably the opposite has happened, and it's placed too much downward pressure, and it's been too effective in controlling wage outbreaks, given the fact of what we're seeing here. So I just encourage you you can utilize this for your microeconomic analysis, particularly around the labour market. Super relevant. Yeah. Anything you wanted to add around wage growth, Terry, before we actually now look at what the government's been doing to respond to all of this?
Not really. I mean, if you just keep looking at the numbers, it's just quite shocking, really. So we got private sector wages up 0.5% in the quarter for 1.9% for the year. Public sector even worse at 0.4% with an annual rate of 1.3%, which is basically an all-time low. You've got the head of price statistics at the ABS saying that this result was one of the lowest ever recorded by the Bureau. And it just really paints quite a drab, dreary picture.
Now, I think there's a couple of things to sort of note here, right, that I would just quickly highlight to qualify the data that we're seeing. One is that what I observed is that, there has been quite a bit of different sort of wage growth across industries. So there's been a fair bit of industry variation, right? Given the shutdowns that we've seen, you can see that there are certainly some industries like arts and recreation that have, given the state of the industry right now due to COVID, are going to have significant downward pressure, I would argue, right, on wage growth as a result. And then you've seen that, there has been some more growth in, other services, professional services and construction, probably the three industries that have been able to survive relatively well during COVID, and be able to sort of continue. And so, again, I'm mindful that some of that is also a result of just the situation that we're in. And, it might be hard to expect to see significant wage growth when you've got big parts of the economy, struggling. The second thing that I would probably, draw out from this is that, we have had in July, there is the minimum wage increase that is, that has gone through, and this data doesn't yet reflect that. Now, the extent to which that will significantly change the outcome, it may not be significant, right? It may have a small dent, but I would just highlight that, what the government has done, and they did this pre this data coming out, so you wouldn't frame it as a policy response, but just rather, an action that was taken was that, the Fair Work Commission did identify to, despite COVID, lift the minimum wage. And so that will flow through a little bit, which may hopefully soften some of the erosion in real wages that starts to, really flow through in this new financial year. What's the government been doing, Terry? I think this is the critical thing. Now that we've got a clear sense of context, like, what are they doing and is it enough?
Well, I think, yeah. So the most important thing is that they've recognized that once they've placed everybody back into lockdown, that they do need to provide some form of support. And I think that's where we're going to focus on as our policy response as well. So the big one is the COVID-19 disaster payment. And basically, workers who have lost up to 20 hours or there's different payments based on whether you've lost up to 20 hours or over 20 hours of work. They will be paid a flat rate, basically, and this is, I believe, funded by both the state and federal government. And so they're still getting paid whilst they are not able to work due to being locked down. And then we've also got the pandemic leave disaster payment, which is basically those who've undertaken a test, tested positive, or have had to self-isolate because they've been in contact with someone who has COVID-19 and couldn't go to work, and therefore give them some payment for that as well.
Mm-hmm. Now, there's a couple of things in here that I think are interesting, right? Like one is it's co-funded, state and federal. So in some sense, federal government, it's going to help their budget outcome a little here because they're not needing to bear the cost all themselves, which my understanding is what was the case under JobKeeper and JobSeeker. Now, to be fair, the states last year did provide other financial support, whether or not it was through, business support, payroll taxes, grants and the like. So, it wasn't that the states weren't doing things last year, but looking at it, it seems like it's been a pretty good deal for the federal government in that they've been able to get agreements for it to be co-funded by states, which does take a little bit of pressure off the federal budget. In terms of impact at the moment, and look, you always want to, I think, you always want to read the data the government ministers give you with a question mark, right? Because obviously it's in their best interests to say that it's being successful. They have highlighted that, since July 2021, in the month of July itself, I should say. So in a single month in July, and this data, there's not a lot of it floating around yet. So as long as you have one that you can perhaps reference, that's going to be sufficient. They said that 680,000 individuals in the month had received, COVID disaster payments totaling $827 million. So you can see that a significant number of people lost work, which is why when we looked at that unemployment data and we were looking at, the sort of total hours worked and so forth, you can just tell that number is going to shift significantly. Now, my question for you, Terry, is why did they do this and not just, do a JobKeeper 2.0, like reboot JobKeeper, given that arguably, right, JobKeeper was very successful last year in minimizing the growth in unemployment?
Well, I think with the COVID disaster payment, I think it's a little bit more direct. I think with JobKeeper, it had to go through, it was a subsidy to employers first and foremost, who would then provide it to employees. And just from recent news, I have heard that there have been companies who have benefited potentially from JobKeeper, who actually were making profits and still claiming it. But at the same time, I think it just places more responsibility on individuals to go out and get these payments as opposed to letting it trickle through.
Yeah. And look, I would say, I think that my observation has been one, going direct to consumer means you get the cash spent in the economy quicker, right? I think that was definitely, to your point, there are a couple of larger, well-known brand names that, yes, claim JobKeeper, and we won't name any of them. No name shaming now. Yeah. But there were a couple, and so I think there was definitely some really negative PR, and there is a political element to this as well. I think we should be mindful of. One, there was definitely some negative, like government media coverage, particularly because the government, and I understand why, they didn't require those companies to pay it back. Their argument was, well, it would provide any business with uncertainty in the future if they claim support when they genuinely need it and then later things, turn out to be okay. It just creates uncertainty about whether or not you can rely on something. And so understandable, both sides of the equation, like, yes, criticism for companies that claimed it but ended up, producing profit. Although in many cases, people benefit from that from super, right? Because many of those large companies were publicly listed. So there's another argument there to yes, it's trickled down. I'm aware of that. The second, though, would be that, equally, yes, it was slower then for them to administer. It was slower for people to get the cash. And so you could argue, well, there's some political reasons why they don't want to do JobKeeper again. And then there is some economic reasons why they don't want to do JobKeeper again. And those are that, how do we get the cash quicker to people? Because that means they're going to be spending more of it in the economy quicker, and that'll support us propping up economic growth. So hopefully we avoid a technical recession. Now, me being cynical, I think the government would be very, very pleased if they can find a way to avoid a technical recession, simply because of the election cycle. and the likelihood of going to an election early next year. And if they can, particularly the Liberal government, and the fact that very much their, political election credentials, I think, are really founded upon economic management, rather than sort of, social welfare or whatever it might be, or environmental sustainability as another example is clearly not.
Why are you doing this?
I know. I'm very sort of cynical about this, in the sense that I think that there is an element here where they've gone, great, if we get the cash to people fast, that's going to be a bit of an election win. If we can use the cash go into people's pockets quickly to get consumption up to avoid a technical recession, another win. And then, of course, the fact that it's a little more targeted, right? Like JobKeeper, I think, was not quite as targeted. This is only in place for when you're in lockdown for a period of time. And so it's really like a dial up, dial down. It's a little more flexible.
Yeah. And I also just want to add on to that, just very quickly with the political aspect. I think also just they probably wanted to just kind of retire JobKeeper and leave that, the wins they had there with unemployment, just leave that one there. And if they got any wins here with the COVID-19 disaster payment, they'd take those wins separately. I think if you have two policies that have worked well, it does play on people's minds a little bit. It looks a little bit better as a political platform.
Definitely. And I think that the big thing was that there was so much negative media coverage, I think, around when JobKeeper was going to end officially, because, that had like a hard date in the future, and when job seeker payments would dial back. And so, again, being a little, cynical around the political motivations for this, clearly by making it connected to when your state is making lockdown decisions. That's not a federal decision. That's now a state decision on when lockdown occurs. And so all of a sudden, the decision on when funding stops is not a federal decision anymore, right?
Very strong marketing move.
Yeah, it is, right? If we're actually going to be a little cynical here, it's a very good marketing move from the federal
government. Only a great marketer
government.
could do that, man.
Well, it's ScoMo from marketing, right? I think we've all heard that before. So, look, I think that's just some stuff there. Now, look, there are some other things that I think is worth highlighting here. One, the government has implemented some increased in childcare support as a result. One, because they're wanting to try to lift anyway, labour force participation rates because of lower immigration and the fact that, that's creating shortages. So getting more people into the workforce is a good thing. What they are doing is that it's going to provide 25% of the childcare centres pre-lockdown revenue to basically ensure that childcare centres can stay open, so they can provide a relief to thousands in Sydney and Melbourne, because they know that if they're not staying open, parents will struggle to work, and that's going to then have impact on, employment levels, on labour force participation, consumption in the economy, economic growth, right? So there is some other stuff they're doing here. Now, what I would say before we do like a little bit of a summary analysis, right, on the overall government spending, is that what I find interesting is that a lot of the policy response, I think, if we draw it back, and I remember I said I would, to consumption and investment, right, given that they're two key drivers, clearly is targeting consumption a lot more. Like it is very much about let's put cash in people's pockets as quickly as we can when they're losing income to ensure that consumption levels remain high. I think what is interesting is, given that business investment is now a negative, it's in the negative zone and it's got there quite quickly. My question is whether or not they're going to do enough to drive investment. And we know that investment actually is a pathway over the longer term to sustainable wage growth that doesn't create inflationary pressure. Right? If you can get high levels of investment up in an economy, right, drives, particularly in capital, right, it's going to drive, wage growth that is more sustainable. And so my concern is actually there's very little, short of some, extensions on policies they did last year, that may actually drive investment in the economy. And note, last year, the state governments were trying to do a lot to support investment. And this year, because they've been hit up for a co-payment for the disaster payment, there's a lot less there. And so, I think that bodes for me as a concern in evaluating government policy. I don't know if you have any thoughts, Terry.
I'm just going to go back down on the political route, really. I think at the end of the day, you're going to be able to win. You're going to be able to buy more votes if you go for consumers and households. as opposed to businesses. And so I think, at least in the short term, while this election is looming, I think they're making a very shrewd political move just to go after more discretionary spending from consumers as opposed to supporting households, which is interesting, I guess, because this is a federal government which does pride itself on its support for small businesses.
Yeah, that's right.
And so I'm wondering if there's a bit of it's not matching. What to do is there's almost a bit of a divergence.
Yeah, no, I think that's true. I think you're right. It will be interesting to see if they exactly. It's just a matter of let's focus all the resources we have on the stuff that we think is where we need to right now. Consumers. But for me, I think it is interesting about how sustainable that recovery is. And so what I'd be recommending from an analysis point of view is one, it goes to that overall question of, what was already in place going to really create a sustainable recovery, right? And maybe not. Secondly, I think the interesting thing here to highlight before we just look at a quick overall impact on some of the spending outcomes would be really for students, don't underestimate the value of being, bringing up the political limitation card. And what I would say here from an analysis point of view is when I often read essays that bring it up, it's often done poorly, right? It's often done in the sense that it's almost like a throwaway sentence, oh yeah, there's political limitations, right? And there isn't often a lot more that is said, which then is just not that sophisticated in terms of analysis. Now, where students that do it better, and not best, but better get to, I find, is they'll at least draw it more explicitly to an election and how that might be driving decision-making. And then the students that do it best, right, are the ones that can connect it to a specific policy, rather than just saying overall, they're spending lots of money on blah, because of an impending election cycle, and that's why they want to have a surplus budget, or they want to try to get fiscal discipline tighter, right? The best is where you can still bring it to be like we have here, to be well, look, the reason we have got this COVID, disaster payment and it's structured despite a successful JobKeeper last year is probably purely because of the political impacts, right? Yeah. I think if we're being really honest. So I don't know if you have more to say, Terry. I know you see a lot of this as well in your marking.
Yeah, I think it's just, you're 100% right. If it's done well, it can be such a strong, powerful argument. But then if it's just slotted in there tokenistically, it definitely is that way. And I don't think the students themselves are completely to blame here. What I will possibly pass the blame onto is just the way that it's taught in the course, in the textbook. I think there's, 2 paragraphs dedicated to it. I don't know if that's an intentional thing, to try and be apolitical as a textbook. I totally respect that and understand that. But in an essay where you really critically analyze and evaluate policies, I think, given we're past the point where we can't be political. I think in times past when you and I were doing this course, you could have probably gotten away without going political with it. But I think we're past that. We live in such a just dramatically political environment now. Kids at school, you guys know about politics. When I was in school, it wasn't something which we talked about. There was the weird kid that liked politics, and that was about it. But I think it definitely has a place in the course now, and I think I would highly encourage students to just add that in there.
Yeah, no, I agree.
Really.
And I think that's it. I think what I really try to encourage is, if you're not engaging with politics in economics, try to engage with it a little, because it actually will overall enhance the quality of your analysis when you can start to see that there are certain lenses that different parties have in how they view policy. And then that gives you a framework to start to analyze. Now, you don't certainly need to, pick a side, so to speak, in your essay and be this is the, and I'd avoid doing that. Yes, you want to be political in recognizing that there is political ramifications that are driving decision-making, and therefore just be critical about the possible outcome. But yeah, at the same time, be a little more political, pay attention to it, but don't make it a political rant, I think is the point I'm trying
there is a balance. There is definitely a balance.
Yeah, that's it. So just wrapping up, look, the government data shows so far, about 1 in 10 people in New South Wales, or now 882,000 people, have been paid $2.5 billion in assistance through, there's three sort of programs, but largely the COVID disaster payment program and the disaster leave payment program. In Victoria, it's been a little less, but again, that's simply because they went into lockdown later than New South Wales. So 347,000 residents, 653 million, and then another 234 million has gone to Queensland for 180,000. So I think, if we sort of look at it, right, there's a lot of money that is being spent. It's continuing, to be spent. I think part of what you need to sort of then come to is a question of, okay, as the data comes out, is it proving to be enough? Is it targeted enough? Is it hitting the right things? Now, one final note, Terry, what's happening with QE? Because along all of this, right, QE was expected, the debt purchases were expected that the RBA was making to start dialing back, right, from 5 billion a month to 4 billion a month, right? What's been going on? Has the RBA come out and said anything on this?
Yeah, so they just had a recent meeting. So, in their monthly meetings, they have recognized that they might possibly need to drop this plan, put it on hold for a little bit, possibly just because, the financial impact from these lockdowns has been quite, severe, and that they might still require a little bit more support moving forward.
Mm-hmm. And that's it. So at the moment, what they've actually said is they've just delayed that decision to cut back. So they've said, you know what, we're going to keep going until really, early sort of, from September, maybe we expect maybe till November, like we'll keep it through September, October. And then we'll say, look, we still need to dial it back, but we're going to keep the cash coming, which is obviously going to help in, really significant ways just by continuing to increase the money supply in the economy as well. So look, any final comments, Terry? I mean, I think that's, hopefully a really good overview on the economic update on the stats, the current policy response that's updated on the budget, that the government released earlier this year, and some analysis. And I think what I've loved about this is also, I think what we've been doing is unpacking and trying to explain a little bit more how you analyze in a way that's a little more effective. Were there any sort of final things from your end?
No, I think it was good. I think it was really good that we were able to get a little bit more into it. I think you kind of opened the floodgates when you started, getting a little bit political. So I got a little bit political, but I think that it's a really great point that we could elaborate on, just about students having that voice and their own perspective and thinking things through, because that would still be the issue, which I see, I'm having, done recently trials at my school, right, and seeing just how those have gone. I think the key is still students in economics aren't wanting to take risks a little bit. Like they're playing it a little too safe, just reporting things as they are. But no, that's not it. There's so much to the subject, and it's such a living, changing subject. Not doing it would just not do it justice.
Definitely. No, I think that's an awesome way to wrap up. So guys, look, if you've got any questions about what we've shared, let us know, leave it in the comments below. Love to know if you've got a perspective on the effectiveness of the recent fiscal disaster payments and leave payments. Let us know in the comments below. Otherwise, keep tuned. We've got more episodes of HSC Economics Review coming. And all the best as you navigate the awesome highs and lows of the economy right now. See you guys.
See ya.